Policymakers.com.
And we're back here in studio. We got Jared Parker in the house. He's an economist here, based in Tampa Bay, does a lot of work out in Tallahassee as well. We're going to talk about the CPI numbers. Report just came out, jobs report, as well as the business rent tax coming up here on the show. Later on as well, we got Gunnar Bernanke, Guardian Protection, Home Security, and Automation coming up on the show as well. Before we do, we always like to feature our listings. We love to feature our real estate listings live on air. 4501 Garnett Drive, Newport Richey, another waterfront listing from the Platinum MVP team at Keller Williams Realty. 4501 Garnett Drive, 2 bedrooms, 2.5 bath. 2215 square foot. We just did a price improvement. We got open houses coming up as well. Great opportunity to own a waterfront property. Bring your boat, bring your jet skis, enjoy that Florida lifestyle to the fullest. Now, you got a lot of community amenities as well. Waterfront clubhouse, heated pool, tennis courts, private community boat ramp, plenty of parking as well. Great opportunity to own real estate in Newport Richey, Florida. 4501 Garnett Drive, Newport Richey. 7532 Yachtsman Drive in Hudson. This is another waterfront listing. Beautiful property from the Platinum MVP team. Keller Williams Realty, 2 bedrooms, 2 baths, 1632 square feet. Yachtsman Drive in Hudson, Florida. You're on a canal that feeds out to the Gulf of Mexico. You got a brand new kitchen, granite countertops, top of the line, stainless steel appliances, and more at this beautiful property in Hudson, Florida. And you can see all of our listings at PlatinumCoastalElite.com. Check out PlatinumCoastalElite.com.
This is God's country.
All right, Jared Parker, welcome back, sir.
Oh, thank you for having me. It's always fun.
My pleasure, man. Yep, good to have you in. I love talking about economics and, the economy, just the way that these things affect. And I want to start with the jobs reports because, over the last 12 to 13 months, I think it was, the federal government comes out and they say, for example, 350,000 jobs created, and then you get the pom-poms, everybody with the pom-poms on all the major fake news sites. Oh, yeah, look at this, created these many jobs. But then what happens is most people don't realize, and it's kind of anchored in the minds of consumers and business owners and regular, ordinary citizens alike. It's anchored in their minds. Oh, wow, the 350 jobs were created. But they don't realize the very next month they come back out and they revise those numbers down by just about 100,000 jobs, right? So isn't that just a that should be almost illegal to do that.
It's funny the way they do it. It's not. I wouldn't say there's a giant conspiracy per se, but what I would say is that there's three sets of surveys that they pull when they try to calculate jobs. What they'll do is they'll do the payroll processors. So I think it's ADP is the largest payroll processor. So they'll get data from them and they'll count that. They'll then run what's called a QECW, which is a quarterly employment survey. And it's a survey. So you don't have a good count necessarily because people lie on surveys.
Okay.
So they'll put that number out there too. And then the census actually does a third one. And they do what's called a household survey.
Wow.
So then they ask actual households. So one thing is you're asking the employers, how many people do you employ? And they'll tell you a number. And then the households will sit there and say, well, this is how many people I got working in my house.
Right.
And those two numbers never agree. And they should. But you look at the total, like over the course of a year, they might be $1 million off.
Wow.
So where the revisions come in later is basically double checking those surveys to sit there and say, hey, what's the real number?
Yeah.
Based on what they're standing. And whenever you get that first number, same thing with GDP. You get the first GDP, you don't typically want to take it to heart because they're going to revise it.
Right.
And we just had last quarter GDP was 5% nationwide, 4.9%. That'll probably get revised down a little bit is what I would expect. So it's one of those things where people like to run with it if it's good news for them.
Exactly.
And they'll go with it. And if it's bad news for them, they'll brush it under the table.
Yeah.
But at the end of the day, the numbers change.
Yeah.
And it has to based on the nature of how they collect it.
It seems a little bit like it is a pattern, and when it's 12 or 13 months in a row, you're constantly overstating the jobs report.
Oh yeah.
You know what I mean? So it does seem...
if I'm the president and it's in my favor, I'm going to shout that first number all day long. And
exactly.
That's the disingenuous part.
Right, exactly.
They know it better than I know that those numbers are subject to change.
Exactly. That's a good word for it, disingenuous. CPI report came out. What's the latest?
So, inflation's up. Kind of shocked everybody. I think they were expecting... So they track it month to month, and they do the 12-month. So I think 12 months right now, we're about 3.9%.
That's a trailing.
That's the 12. Trailing. Yeah, they look at the prior 12 months. How much the price has gone up today versus 12 months ago.
Yep.
The change is about 3.9%. The feds want 2%. And the reason that's a big deal is that if they can get to 2%, then they can start cutting rates.
Right.
And the second you cut rates and you've got all that money that's pent up in the economy, it's going to release.
Mm-hmm.
But because the inflation report came in a little bit higher, month to month, prices change about 0.3%.
Yeah.
So between, let's see, what month are we now? February. So between, I guess this would be December to January would be this number.
Yeah.
It went up 0.3%, and they were expecting 0.2%, which is a big deal because they try to price that stuff in the markets ahead of time. All the hedge funds, all the guys looking at the numbers.
Right.
And when that's wrong, everything tanks. So that's why you're seeing a little bit of the tanking. But the crazy part is a lot of it was housing prices that are driving up the inflation. About 90% of that increase was tied to growth in shelter costs, which is housing. And my feel is that Florida's kind of been here.
Yeah.
So the inflation isn't really impacting us as much as it is the rest of the country, where they're starting to catch up because there's housing pressure everywhere. And you're starting to see that in the inflation reports.
Right. Yeah. And the scarcity, we talked about that in previous shows, the scarcity, the lack of homes, and business owners, for example, if they're renting, even tenants, not owners, but if they're renting the where they're having a shop, for example, I was noticing on the news the other day, it was a breakfast shop, and they were doing lunch and dinners for people, and just a little. He's like, I got to move out of here. I can't continue to pay the rents because the landlord is increasing the rents, of course, to cover his nut with the insurances, etc.
Yeah. Oh yeah, I mean that's a big driver of rent and property costs is just things like insurance and the pieces that you don't think of, off the fact that it costs this much utilities. That's another thing you see price increases in.
Yep.
And all those costs got to get covered in the rent. Plus the landlord needs to make something.
Right.
I mean they can't be expected to do it for free either.
Right.
And I think a big piece that we've been seeing nationwide, and we saw this in Maryland for a study we did, is that you're having a lot of people that are leaving single family homes because they're high values. They can sell them.
Right.
And they're jumping into apartments because to get a new house is too expensive.
Right.
And that's driving up the rent costs. So even though in other parts of the country you might not see the big migration flows, but you are seeing the property value grow.
Right.
And as a response to that, people are sitting there saying, hey, I can get some money for this.
Yeah.
And then they got to go live somewhere. And then where are they going? They're going to the multifamily. So you get the rent hit, you get the property hit. It's just price increase across the board.
You know what's interesting? I want to follow up on. There was a story in the news a while back about the House, I believe it was looking to eliminate a lot of the hedge fund buyers. Because that was a trend that we had that forced a lot of veterans and first time buyers out of the market in lieu of these cash buyers, these hedge fund type buyers. And unfortunately, it's the BlackRocks and some of these bigger buyers. I want to find out. I got to research that again and see, unless you happen to know offhand. But I'm wondering what happened with that, and I think that's a good legislation, right, to help the ordinary worker, the blue collar workers, to be able to buy a home, veterans, first time buyers.
Yeah, I know there was some movement up there, and I haven't heard much recently, but the big issue with the BlackRocks, for example, is that the second they go in and buy a house in a neighborhood, they overpay, and because they overpay, it targets the rest of the neighborhood's pricing for people that are to sell their homes, because they can go look and sit there and say, hey, the neighbor got this much money for it. This is how much it's worth.
Right.
So it puts all the inventory in the hands of the hedge funds or BlackRock or a lot of foreign money too. When you look at somewhere like, let's say Pacific Northwest, California, New York, Miami, you get a lot of money coming in from other countries that are tied because they don't have the capital markets, they don't have stock markets, they don't have places to put cash.
Right.
So they then look to American real estate and they come in and buy.
Good point.
That also pumps up a lot of the costs. So that's another one of those problems that you can't wave a magic wand to solve it.
Right.
But it's something that you've got to solve. You've got to figure out a way to
that's very interesting. We're talking with Jared Parker here, economist. He's Regional Economic Consulting Group, helps us out with some of our real estate properties as well, doing rent studies for municipalities and all types of different impact studies here on a local level. If you have any interest in speaking with him, reach out to us. We'd love to talk to you about that as well. Jared, you mentioned that when that foreign money comes into the country, two things come to mind: the BRICS, the challenges with the BRICS nations. Whenever I read articles or hear podcasts, there's more and more nations jumping on board there. I think even Saudi Arabia jumped on. But what do you see happening with the United States dollar and also inflation? We talked about earlier the impact of all this printing. It looks like they're trying to ram through another bill to send more money overseas rather than take care of our southern border. But what's your thoughts around that?
It's just the dollar in general. I mean, the dollar in general, it's U.S. is the world's reserve currency, and it's really, and what that means is that a lot of people throw that term around and they don't quite explain it.
Yeah, exactly.
It's basically the idea that if I need a reserve, I need a backup. Where do I go? Like if I'm in Argentina right now, where they were having the crazy inflation down there. If I own property there, I can sell my property. I can go move it into a house in America, and which is denominated in dollars. Same thing with if I'm a bank. If I'm a bank in Argentina, I need some kind of backup to the inflation because the government still have to spend money. They still have to trade and all that. So what they'll do is they'll have like a reserve portfolio and they'll mix it with a bunch of different currencies. But the dollar is the primary driver. That's because the U.S. has such a unique position in the world that no other country has. It's the fact that we've got, I can go on for hours for this, but it's a combination of the economic resources that we have in this country, and it's also the ease of how we can move stuff nationwide. We've got a river system. We've got intercoastal areas. We've got a highway system. Most countries don't have that. You go to Russia, they have a hard time getting crops on a train and getting it to port and shipped out before the crops rot.
Wow.
Because it's so hard and expensive, which means they need to invest in things like more refrigerated carts. They need to invest in more expertise. We don't have to do that. So we get all the extra cash. So we'll always be a very dominant power in that framework.
Yeah.
But it doesn't mean we can't put roadblocks in our way. It doesn't mean that we don't need to be responsible with the way we spend. And I'm a fiscal conservative. Yeah. And I think when we spent over $9 trillion running through COVID was ridiculous.
Unbelievable.
And it's like, can we hurt it? Yes. Can we really, under the current setting and the framework of the U.S. of the world, the U.S. is always going to be the most advantageous position. So it's like it's a short-term problem. Long-term, I think we'll be okay.
Yeah. I hope you're right on that. It's kind of scary when you look at the rise of digital coins and the Bitcoins and all these different things coming at once with the BRICS nations combined with that. So we're talking with Jared Parker here, local economist, Regional Economic Consulting Group. I'm your host, Brandon Rhymes. The next topic, business rent tax. Tell me what's new in that space.
So we are part of the House wants to do their tax package every year. Normally they try to cut a couple billion. They'll try to cut $1 billion or so. I think last year we did 1.5 or 2. Part of that initiative this year is business rent tax. So this is the tax that if you own a property, you own commercial properties, you pay sales tax on that, commercial rent or business rent, the two terms. We just did a paper for the Florida Realtors to cut that, and we want to drive it to zero. Originally, they passed some legislation earlier, about 2 or 3 years ago, that said they wanted to introduce online sales tax collections. But they didn't want to create an additional burden on the economy by increasing taxes to do that. So they wanted to offset it. They sat there and said, okay, we're going to increase sales tax, or we're going to get taxes from online, but at the same time, we're going to start cutting down commercial rent. And we'll cut commercial rent as it fills up the unemployment compensation trust fund. So that's when you go to claim unemployment. That's where your money comes from. So basically what's been going on is that sales tax has been coming in fast. The economy's been hot in Florida. That fund is filled. So now we want to get rid of the whole thing.
Okay. And
so my company did the study on removing it, driving it to zero, and we found that, these guys are going to have, especially the top guys, the top 20% of commercial rent taxpayers, they're going to have anywhere from $300,000-$400,000 to a couple $1 million in their pocket extra when this tax goes away. And our argument is that they're going to reinvest it. They're going to start expanding their portfolios because they got to put the money somewhere.
Right.
Why not Florida?
Yeah.
Florida's a strong, growing economy.
That's right.
So we did the study. We found that based on the construction, there's going to be about 45 to 50,000 jobs created just building new buildings, building new businesses. And then additionally, you're going to have another 4,000 to 5,000 new employees that are going to staff those businesses going forward into the future.
Yeah.
So it's about almost $1 billion tax cut to the state. They'll get back about $300 million of that from just general economic activity.
Yeah.
But you're also talking investing another $4 to $5 billion in Florida.
Wow.
So it's like this is a headwind under the current framework.
Yeah.
And we want to remove it. And we have to remove it because we have 1,000 people moving here a day.
Exactly.
So they need places, they need restaurants, they need retail, they need office space.
Right.
So this is a good way to get there.
Yeah, I like that. That's a smart move. I like that, and how you broke it down. I mean, it makes a lot of sense. We have to bring in more housing. We've got to get more housing. How do we fund it? And it's all a complicated deal. That's the thing with, this economy, man. There's a lot there. It's a lot to meets the eye. How do you want people to connect with you, Jared?
My website, regionaleconomicconsulting.com, is an easy way to get to us. There's a little contact us button on the homepage or on one of the pages. Yeah, reach out and one of us will get back to you.
Regionaleconomicconsulting.com.
Correct.
All right, good stuff. Jared Parker, always a pleasure. Thanks for breaking that down, man.
Absolutely.
That's a dynamic conversation. We could go on forever with this stuff. I love it. It's interesting. I love economics and, the impacts and how it affects things. And, there's people that need housing, and there's so much there to go. But,
absolutely.
That's unfortunately our time for today. Thanks again.
Yeah,
Appreciate that. All right, taking a quick break. We're going to come back, talk to our security expert Gunnar Branecki on the Consumer Quarterback Show. Follow us online. We'd love to connect at Brandon Rhymes 1 at CQB Show. More with Gunnar Branecki coming up. Consumer Quarterback Show, consumerqb.com.
This is Work Done, and you're listening to the Real Estate Quarterback Show hosted by my man, Brandon Rhymes.